Have you ever wondered who actually pays you in stock market when stocks go up? It's not what you think. It's not the company you bought the stock from that pays you when the stock price rises. If you buy Nvidia stock, Nvidia itself isn't going to pay you just because you bought their stock. That's interesting, isn't it? So then, who actually pays us when a stock goes up? Why do stock prices rise? That's exactly what we're going to discuss in this video, guys. It's a really interesting topic, so let's dive in. When you buy stocks, you usually don't buy them directly from the company. Most of the time, you're buying shares from other investors in the stock market. These are normal people who already own the shares and are willing to sell them to you. For example, when you buy Nvidia stock, you're usually not buying it from Nvidia itself. You're buying it from another investor like you through a stockbroker. So when stock prices go up and you make money, the money usually comes from another buyer in the market who is willing to pay a higher price for your stocks. And when you buy stocks, your money goes to the person selling those stocks. Companies normally sell shares directly only during events like an IPO, initial public offering, where they release millions or billions of shares into the market. After that, those shares mostly circulate between investors. People like you and me keep buying and selling shares to each other, while brokers help all of us make those transactions happen instantly. And it's not just retail investors participating in the market. Big players are involved too. Banks, mutual funds, hedge funds, large companies, they are also buying and selling shares in the same market alongside retail investors like us. Okay, now let's discuss why stock prices rise and why people are willing to pay higher prices for stocks. Everyone buys stocks for two core reasons. I'll explain both. The first reason is belief. Belief is extremely important in the stock market. If people don't believe in a company, the stock market doesn't work the same way. If a company is growing and expanding, people generally believe that the company's share price will go up in the future. So they buy the share because they believe they can later sell it at a higher price. I'll give you an example so you understand it clearly. Imagine you bought a share for $100. Now let's say someone else believes that share could reach $200 in the next 5 years. If you decide to sell your share for $120, wouldn't they still buy it from you? Of course they would, because they believe they can still make profit in the future. That belief is what makes people willing to pay you that extra $20. And that's one of the main reasons stock prices rise. In many ways, belief is what gives a stock its value. That's why people and institutions are willing to pay higher prices for certain companies, especially if they strongly believe the company will continue to grow in the future. Now let's talk about the second reason share prices rise. It's because of dividends. For example, if you own a strong dividend-paying stock, some investors may still be willing to buy it from you at a higher price because they know the stock can generate income through dividends. Let's say you bought a share for $100, and now you're selling it for $120. Why would someone still buy it? Because if the buyer believes they can continue earning a good dividend yield, maybe 3% to 5% per year, they may still see value in buying the stock at that higher price. So in this case, the dividend is part of the reason they're willing to pay you more. So overall, stock prices rise because people believe the company will become more valuable in the future, or the stock generates income through dividends, sometimes both. I hope now you clearly understand who actually pays you in the stock market and why stock prices rise. If you want to learn more about the stock market, check out my stock market playlist on this channel. Thanks for watching, and I'll see you in the next one.